Right. So when you say maximizing stock price, it's not even maximizing the stock price to be specific, to be precisely correct. It's not even maximizing stock price. It's maximizing shareholders' value. That's what, right? Now, but maximizing stock price is included there, right? But why maximizing stock price is a good thing? Because as we saw, and we will see, stock price has all the eternity in it. All the incomes coming into up to the eternity is included in the stock price. So if you maximize stock price, that means you are doing good all the way to the infinity, right? Because the stock price has all the cash flows discounted from infinity. So that's a better goal, a stock price. But sometimes even maximizing the stock price even becomes in conflict with maximizing shareholders' value. And that's when the dividend comes in. When you are paying dividend, you pay dividend or not depending on the maximizing shareholder value. Because when you pay the dividend, you are doing shareholders a favor, even though your stock price is going to drop, right? So eventually you are hired by the shareholders and you have to do them good, shareholders, which again includes stock price to a great extent. So be careful about these nuances, right? But this was the old formulation. Nowadays, last, I don't know, 20 years, last few years, people are concerned, and then you have to be socially also responsible. You have to be, your business has to be sustainable. You have to care about all, not only your stockholders, but you have to care about your stakeholders, right? Your environment, your community, everything, okay? So that has taken precedence. You have to care about your stakeholders in general, not just the stockholders. Now, let's go on. This is the definition. Let's go. So in doing that, you have two major jobs, right? You have two major jobs. Selecting projects which are NPV positive, and also when you do the financing, you have to optimize your capital structure, right? You have to decide whether you want to borrow or you want to issue equity, and that way you want to maximize the firm value, both ways, right? And also we told you that it's easier to make profit choosing the NPV positive projects as opposed to going to the financial markets, right? Maybe the capital structure has to do with the financial markets. And we told you because financial markets are efficient, it's difficult to make money there. So you are better off to make your money on the NPV plus projects. Now, after saying all those philosophical things, then we came on the issue of very important issue of present value. Okay, and that is where my wisdom has a little bit improved since the beginning of this course. So I try to say something. I don't know how it's going to comes out, but I claim, if it comes out good, I claim I haven't seen this explanation anywhere, including MIT or Yale courses or anything, right? This is a very beautiful explanation with a caveat. So this is my take on it, right? This is my interpretation. I'm trying to make it intuitive and common sense, but also according with the fact. So what is my definition? This present value is this. First of all, present value, again, this is my definition. So with that caveat, take it. These are not in the textbooks, that's the whole point. Nobody says it as explicitly, I'm going to tell you. So present value is not something absolute. This is important. Present value depends on the person, okay? It's case by cases. There is no absolute present value. So what do I mean by that? Again, this is new, right? Nobody says it as I said it. So here's the story. If you borrow $100, right? If you borrow $100 for an interest rate of 5% interest rate, right? This is at the heart of this present value. That's where the makes sense comes in. Okay, so you borrow right now, today, you borrow $100 at 5% interest, right? And then you are looking at a business that is paying you $200 next year, right? This is today. This is next year. So to make a decision, that NPV decision, net present value decision, you need a discount value. Because the 200, you see, everybody agrees the $100 today is $100. But $200 next year depends who you ask. How much is it worth it, right? What is the present value of $200? It depends on who you ask. There is no absolute agreed upon value, right? For you, because you want to make a decision on a business, right? For you, this $200, because you have borrowed, your cost of capital is 5%, right? You borrowed $100 for 5%. So, and you want to make a decision on investment or not. So for you, you have to present value of your $200, right? Present value of $200 for you is 1 plus 5%, okay? Because your cost of capital was 5%. So you divided by 5%, 1.05. If I borrowed that money for 10%, I have to, my discount factor would be 1.01, 1 plus 10%, okay? So this is very important, okay? Because what? You are trying to make a decision to accept this investment or not, right? $200 is good if you borrowed your $100 for 5%. But if you're paying 50% for your $100, maybe $200 is not good enough for you, okay? So it depends. Now, let's say you didn't borrow $100. Your daddy gave it to you, right? Donald Trump says his dad gave him $1 million. Other people say it was more like $10 million. Doesn't matter. He got it from daddy, right? So what is the cost of, he doesn't have a cost of capital then. So what is his discount value? Forget about Donald. If I get $100 from my daddy, and I want to make a decision about the investment next year, I'm getting 200, there's a business that pays $200 for me next year, right? So should I accept that business or not? It depends on the present value of $200, right? I bring the $200 to today, calculate its present value, and then I can compare it against my $100 cost, right? So, are you guys with me? So for me, that the question was, if I borrow that money for 5%, so I know how to do something. That's what I did here, right? But if I didn't borrow that money, if money was given to me, so what is the value, guys? Yeah. What you put here, right? So for me,
Professor, your voice is
We
breaking.
can't hear you.
Which one?
Your voice is breaking.
Okay, very good. I'm getting excited. Yeah, it's actually, unfortunately, it shows bad. Is it better now?
Your
Yes.
present value is
Perfect.
$190 right there.
Hold on. So I am buying I am getting a gift for $100. I'm investing it in a business that is paying me $200 cash next year. Should I go there for that business or not? How do I go about it? What should I put here? What is my R? What is my discount value? Yeah. If I was borrowing my $100, it would be my cost of capital, right? 5%. But I'm not borrowing it. So what should I put there? What do you think, guys?
Zero?
No, that zero means is even better than risk-free. That is like today, no?
Because it's your money.
Maybe
No,
inflation.
that's true. I'm not paying any interest on it. You got it. But that means I should put zero there?
No, you put the interest, you can use an
The
index
market?
such as, you can pick an index such as inflation or.
First of all, you guys
You can
realize,
use the expected
Maybe you
return
can
for
put,
the
maybe you can
investment.
put for the market, the rate for the market, because maybe this is the,
no, what is the market? No, hold on. But first of all, I want to make sure, I told you at the beginning, I said, I'm teaching this course, and this is, I want to also Farnas listen to this, because he knows people out there, he knows important people. First of all, notice that the way I'm teaching the same subject is much different from the beginning, right? I'm teaching present value, and if you understand, if you notice, this has more depth in it. This is more personal. This is more intuitive, right?
Mhm.
So that's one point. And this question also is very important, right? So show me any video that explains present value that better than I did right now. Only present value, not the rest of it, right? Because I have seen hundreds of videos. Everybody just puts in 1 divided 1 plus R and that's it. What does it work? Nobody knows. Everybody just use the formula. I just brought it down to you intuitively, okay? I said, if you borrowed the money for 5%, first of all, I said it's not the absolute value, it's relative. That's very important. Show me a book who says that. I dare saying that, right? Okay. because I'm not the authority of finance, right? But this is making it intuitive. This is making it so you understand it once and forever. It's not mystery anymore for you, right? So I told you, if you are borrowing $100 for 5%, your cost of capital is 5%. So because you want to judge that $200 next year, it matters how much you know, if you want to make a business decision to go on or not, it depends how much it costs you, right? That's what it is making a decision. So that was for 5%. Now I'm saying your daddy gave you $100 and you guys are not giving me the correct explanation. What should be my discount factor if my daddy gave? Or forget about daddy. Don't want to bring politics into it. I found it on the pavement. Remember, I told you if you see $100 on pavement, forget it because markets are efficient. Move on. No, I picked up that $100 and it turned out to be a real one. And I want to invest that $100 and next year I'm getting $150. How should I discount that $200 next year or $150 next year? But I found that $100. What is my discount value? If you understand this, you understand finance and economics. Very good. What should be R if you found the $100 in the basement, in the pavement, right? So again, you know NPV, right? Your
5, Doctor? Will be 5.
Hey, honey is here. Good.
Hi, how are you?
Hold on a second. So NPV, your NPV would be minus $100 that you found on the pavement, right? That's outflow. You're losing that. Plus 200 divided plus 1 R. Here is what you see. Because you are interested in NPV, this R is your R. It depends how you get that $100, right? So this R is not the same for everybody, right? For you, because you want to make a decision. So because you borrowed 5%, you put 5% here. If you were borrowing 100%, you put 100%. But no, you didn't borrow. You just found it on the pavement. So what do you put here now? It is what do you say, honey? 5%?
Yes, Doctor.
So Dr. Majid, if you borrow for 5%, then your cost of capital is 5%.
Yes. If you borrow for 5%, then you go there. So my cost is $100 now. I'm going to get $200 there. I put 1.5%.
And Dr. Borumand, this is maybe this explanation that you said that it's not a fixed price because this is my money and I didn't borrow it.
Yes,
it's going to be different. For example, maybe I just put a different number because of the risk appetite to another person.
Which one? What was that?
The R that I didn't borrow and it's my money is going to be different from me, for example, to you or the other people, because it goes back to my risk appetite. And because I don't need to just be responsible and be like, explain or make sure that I have to just meet a level or a specific, the R is going to be different.
Good point. Yeah, definitely. That's what I said it very clearly, that R is but how much is it? Okay, we don't have time. We have to move on. But what about risk appetite? There is some truth in that. That's very good. Is basically, remember. I don't want you to forget this. This is economics. It depends on the opportunity cost. You have to see if you put in $100 in another project, how much you get back. So if another project pays you 6%, you have your discount value is 6%. Because that's your opportunity cost, right? So if you don't have a cost of capital, that means if you didn't borrow the money, still you have opportunity cost. That $100 is not free anymore, right? So if you have an alternative project that pays you 6%, you have to put 6% here. Opportunity cost is your best alternative, right? So you put the opportunity cost there. So cost of capital, opportunity cost, and also you can talk about talk about the required rate of return. If we talk about required rate of return, which we talk about later, that's exactly what Farnas said, then your risk appetite comes in, right? What is your risk aversion, right? Because at that case, you have to see how much you are willing to take to compensate you for the risk. So it depends on your risk aversion. Excellent. So let's move on now. So this is the notion of present value and where you get the discount factor. I swear to God, you cannot find better any explanation anywhere. I stand by this statement. Show me, okay? With the caveat, this is my version. So now let's move on to and in the middle, we talk about also NPV too, right? NPV, you see the present. Okay, you see, now you see, you had $100 at the beginning, and you had $200 in a year from now, right? And so you discounted $200 to now, so you can compare it with $100 and see if it's a good business or not, right? Because they are at different times. If you want to compare them, you have to bring them to the same time. So you use discount value, present value, to bring $200 to today, so you can compare it with your $100, right? But you could do the otherwise. You could take the $100 in the future and compare it, right? $100, and then you compare it future values, net future value. It's the same thing, right? So what is your future value? If you are borrowing this $100 for 5%, your future value better be bigger than that, because you are paying 5% interest, right? At the end of 1 year, this is what you owe, right? So this is your future value, and you compare it to $200. So now you are looking at net future value positive, right? Doesn't matter. You want to bring these two money together. Either you bring at present or you go to future. But why people don't talk about net future value? Why everybody talks about net present value, not net future value? Anybody? Why? You get my last argument? You want to compare this $100 today that you borrowed and this $200 next year, right? Either you bring $200 to today, which is present value, or you take the $100 to next year, which is future value, and you compare them. As long as they're in the same time, you can compare them. And for both of them, you need that 5% interest, right? My question is, why people talk about net present value? Nobody talk about net future value.
Because everyone wants to just predict what is because we are living in the now. No one just goes back. I mean, like, I know
that you're assuming, true, that's a very good philosophical point, but you're assuming it's 200, right? Expected, you don't talk exact value, expected value is 200. You assume you know that, right?
Well, but you don't want to work with that 200 because the value of the $200 in future is different from the value of $200 now. So you want to know the value now.
No. I'm saying you do these things because to bring these two money together, right? Either you take future to now, or you take now to the future. You can compare these two numbers, right? The reason is this. The reason is you have only one present value, and you have infinite future values. Understand? So if you have one single cash flow, that's fine. But you have many future cash flows, first year, second year, third year, right? Then there is no meaning of going to future, right? So there is no many future. But you can bring all of them to today. That's why people talk about net present value. Okay? So that's another philosophy. Nobody teaches you finance, teaches you, except that somebody who also knows philosophy. Okay? So sorry about that. So there is many future and one present. That's why you bring it to present, right? Otherwise, we were talking about net future values, which is absolutely fine, right? All right, so let's go, guys. Okay, now we talk about future, and a couple of you mentioned that, which is very good. We don't know what's future. Yes, we don't know what's future, but we assume we know. We talk about expected value. We assume we know the expected values, not the exact value, but the expected value. For example, you throw a die, and it's going to be either 1, 2, 3, 4, 5, 6. We don't know which one is going to be. That's future, right? Unknown to us. But we know it's going to be one of them. We know this much. We assume in finance, we know this much. And we can talk about, we don't know what value is coming. We don't know. But we know the expected value. What is the expected value, guys, of a die?
20%.
Which one?
20%.
What do you mean percent? I'm talking about what is the expected value of a number on the die that is going to show up. If you throw a die, it's
1, 2, 3, 4, 5, 6.
5, 6.
Nice.
So these are outcomes. You are talking about sample space, right? Sample space consists of these numbers: 1, 2, 3, 4, 5. These are the possible outcomes. So these are sample space. But what is the expected value of this experiment? The expected value is, right, is you have to multiply each outcome by its probability, right? So expected value of a dice, the number on the dice is 1, 6, and each of them has equal probability, right? So it's 1, 6 times 1 plus 1, 6 times 2 right? Each one times its probability, plus all of them plus 1/6 times 6. Okay, each outcome times the probability of it. That's the expected value, right? And this is investment. You have investment. There are 5 possible possibilities: good, bad, excellent, outcomes, revenues, for example. So you have an idea about the expected value, right? So in this case, the expected value is going to be 3.5. Okay, which is, by the way, is different from every outcome. You are never going to get a 3.5, but that's the expected value. And what is risk? Now that we are at it, how did you define risk in this class? Arna's knew it pretty good. How did you know this risk in this class? Anybody? Hani, Chika, Firdausi, Flavia, the names are no.
We have to, I think, CAPM -1.
Femi, Kemi, what is that?
We have to, it's CAPM.
Definition. This is like dictionary definition. Dictionary definition of risk. I mean, financial dictionary. How do you define risk? This is very important, guys. How do you define a risky investment? A risky investment was an investment that the value, the expected value, was different from the outcome. And this is exactly risky investment, because the outcome could be 1, 2, 5, 6, but the expected value is 3.5. So throwing a dice is a risky business because the outcome is different from expected value, right? When you buy a bond and you hold it to maturity, I emphasize, if you buy a government bond, not every bond, buy a government bond and hold it to the maturity, you are going to get your $1,000 par value. Come heaven or hell, come hell or high water, not heaven. Comes heaven or hell or high water, you are going to get $1,000. That means what you get is what you expect. There is no risk. Expected value is 1,000, actual value is 1,000. There is no risk in holding a bond to the maturity, okay? But when you buy a stock, then you have expected value and most likely the actual value is going to be different, right? So the larger is the spread and dispersion between these actual values and the expected value, the riskier the investment, right? The riskier the investment. All right. Now, that takes us to the next issue. And the other factor is this, that we talked about it, right? Let's see how much time we have. Okay. We played this game, right? That I give you.
Dr. Majid, you said the higher the expected value, the higher is the risk of investment?
No. If
the risk,
actual value,
the higher will be expected return.
no.
Okay, can you say that again, Dr. Majid, please?
Definition risk is this: the difference between outcome
And expected.
difference between outcome and expected outcome. Right? If they are different, then you have a risk. For example, in case of throwing a die, the outcome could be 2, but expected outcome is always 3.5. Right? This is outcome, this is expected outcome. So there's a risk in throwing die. You're never going
expected outcome is always more than.
No. It could be anything.
It can be low or high.
Yeah, absolutely, yes. Yeah.
Okay.
Now, for example, your outcome could be 6. Because you throw a die, you might get a 6, so expected is the next outcome, right? But as expected outcome, with outcomes are different, you are dealing with a risky business in finance. That's what it is now. The other point I want to tell you, another game you can play is throwing a coin. And here's the game. I can either give you a $10 or I can throw a coin. If it's a head, okay, $10, no question asked, okay? That's one outcome. I offer you $10, no question asked. Or I tell you I throw a coin. If it's a head, I give you $20. If it's a tail, I give you nothing, 0. What is the expected? What's the expected of the second game? This throwing a coin. What's the expected value of the payoff here?
Head multiplied by 20 plus T multiplied by 0.
But what do you mean by head divided by 20? Multiplied by 20?
Multiply.
I know, but what is head? You cannot.
One like for 50%.
Yes, you cannot multiply letter by number.
Yeah,
Right?
I mean like 50%.
All right, good point. So probability of head, 1/2 times 20. Excellent, right? Plus probability of 1/2, that outcome, which is 0, right?
Yeah.
How do you get $10? So expected value of this game is $10, right? But outcomes, if you throw a coin, is either 20 or 0. This is a risky business. If you throw a coin to get money, you are taking risk. Because expected value is different from outcomes, 20 or 0, right? What was the first procedure? First procedure, just get $100 and go home. No throwing coin. So first procedure is riskless. You get $10 and go, no risk. Second procedure, throwing a coin, is risky. You either get 20 or 0, right? But both of them have the same expected value, right? Both of them have the same expected value. This one gives you 10 expected, not actual expected. And this one also gives you the 10 expected, right? This one is risk-free, this one is risky. So who's gonna, and last time we talked this, I remember Fatima said she's not gonna accept a coin. She said, give me the $10, right? Are you gonna accept it now, Fatima? Did you change your mind?
I remember.
No, but do you accept it now or no? Which
It's
one do you
still,
accept?
I mean, it's just $10. I know it's double the amount, but it's still $10. So I would still stick to like, no, I'll take the $10.
Okay, so she is, if she accepts, even though expected values are the same, but the second one is riskier, that makes Fatima risk averse. Okay? People usually are risk averse, right? If the, guys, please mute it. If the expected value is the same, they want a less risky one, right? So because people risk averse, okay, now let's do this. Let's do the same game, and I change the game. I say if it's head, I give you $30, and it's a tail, I give you $5 or zero, even $0, right? So who's gonna play this game now? What's the difference now?
I'm in.
I'll play this game.
You play this game. What's the difference? What happened? What's the difference
15. The expected value is going to be 15.
Now expected value is 15. Expected value, I raised the expected value, right? So somebody might not accept the first pro-coin game, but they are going to accept this one. Why? Because expected value is higher. So people might accept taking risk if the expected value goes higher, right? So they want to be compensated for the risk, right? So that takes us to the second very important notion in finance, that the risk that investors take, they expect to be rewarded for the risk, right? They want a higher return for the risk, right? Higher risk means investors require higher return, all right? Now, the question is, so for any investment, right, the return, for example, let's say a stock, investing in stock is risky, right? If you want to invest on a stock, your required rate of return, you only invest if the expected return is risk-free rate, right? At least risk-free rate, plus something proportional to the risk, right? Some risk premium, basically. Right? And that is very important, right? If you want to, if the outcome is different from expected value, if the investment is risky, if the venture is risky, you want to be compensated for it, right? And then we are going to see how much is going to be this risk premium. We're going to get to that. But before that, we have to make a distinction. What is the distinction? There are two kinds of risks. Diversifiable, right? And the other one is systematic. Guys, mute please, right? Diversifiable and please, go ahead, guys. Mute.
You should come and see him. That you include your name.
Somebody is not mute, guys. And we know somebody from Nigeria, and it's a female. That's the information asymmetry we have.
Be sure that you're not on education line.
Are you guys listening? All right, so we have two kinds of risk, right? Systematic and diversifiable. Unfortunately, in finance, if the risk is diversifiable, nobody's going to pay you anything for it. Only systematic risk is compensated, right? And I have to go kind of shortcut here.
I'm sorry, Professor, you can mute everyone from your side.
Yeah, I
because
was about to tell you that.
Yeah.
Mute everybody because it's distracting us.
Which one is the?
These guys.
Never figured it out.
I think it's Kemi, but
No, I know, but where is the mute part? That's what
I mean,
saying.
the three dots, and there, your
Oh, I see.
cursor is, yeah.
It says, no, it doesn't say anything, or the mute. The one that says the pause recording and everything, no, it doesn't have the.
No, you have to go to, I mean, for example, my picture there, up there, and you can
On your
see
right side,
and
top,
three
the three dots.
When you move your cursor, you can see on my picture three dots. Yeah.
But there is no general mute, only personal.
No. You can mute, but whenever you are actually setting your record, you can just generally.
I think she's muted now. We can continue.
Yeah. Okay. Yeah, guys. This only happens when people are talking and not listening. Otherwise, they would mute it, right? They probably leave their machine. Anyhow, so risks are two kinds. Diversifiable, you are not going to be rewarded. For systematic risk, you are going to be rewarded. And the relation is this is CAPM. That takes us to the CAPM. Very, very important notion, right? Again, CAPM has its own flaws, but this is it. So for example, for any security, could be a stock or anything, the required rate of return is going to be risk-free rate plus beta of that security. Let's call it beta S. That market risk premium, RM minus RF, right? And what is this beta? So basically, you're only going to be compensated with the systematic risk. And this beta S is this. You can drive it from regression, but the formula is this. Beta S is the rho sigma S divided by sigma M. This rho is the correlation between that security and the market. Okay, so this is indicative of systematic risk, right? If something doesn't have any correlation with the market, you are not going to get rewarded for that risk, right? It has to go up and down with the market. Rho times sigma S divided by sigma M, okay? So that's true about every security. And we talk about how to calculate also sigma from regression. Now, what else we have to talk about? By the way, you can guys ask questions.
Oh, quick question about risk premium.
Go ahead, please.
So this is one of the quiz questions I got wrong. So how do you estimate market risk premium in practice?
Oh, yes. Again, Damodaran says there are three ways, right? You can look at the historical averages, which comes out about, I think, 5.6 or something, it was saying.
5.76. Yes.
Or you can do, again, this is actually an important point. We talk about risk aversion, right? This is basically, this risk premium, it depends again on the investors. Basically, if you want to tell investor to invest in a stock, you have to give them some risk premium, right? And so it depends on the risk aversion of the investors. So either you look at the historical value and get the average, or you send a questionnaire out and you get a polling. You poll the investors and you get the average value of that, right? Because it depends on,
another option is implied premium in current asset price.
Implied means yes, because we always have the prices in the market, right? So we can start from prices and back out other parameters like risk premium, right?
Okay, so the answer to that question is all of the above.
Yes, all of the above. Yeah, I think that was the all of the above in the quiz, right?
Yeah.
But it's not the today quiz, so you can rest assured with that. All right, so I know one question out, about 10,000 left. All right, so let's go back now to I want to show you, this is also important. So if you if you take random, if you start randomly selecting the stocks, okay, and this is the number of stocks, and this is the risk, right? The key point is the random, like have a monkey throwing dart at the S&P 500, right? Then the risk of the portfolio becomes like this. It behaves like this. It becomes plateau, right? It becomes a plateau, and this is here, this is
Your
systematic.
voice is cracking again.
Okay, so eventually risk, the more stock you choose, it becomes flat. It becomes a plateau. My question is, at what number of stock did risk start plateauing? Right?
You're breaking again. We can't hear you.
Okay, better?
Yes.
So if you have a portfolio of a stock and you measure risk on the vertical axis and the number of stock in the portfolio on the horizontal axis, as long as your stock that you have selected are random, that means you are not going to choose all the high techs, Apple and Amazon and Google and Microsoft. No, randomly. Kmart, Apple, Tesla, Uber, random, right? If your selection is random, after 30 stock, your risk start plateauing, okay? And that risk that is left over, you cannot help, that risk is going to stay. You're not going to kill that. That leftover is the systematic risk. You cannot get rid of it with, rest of it you can get rid of it with diversification, but systematic risk, you cannot get rid of it, right? So that is the systematic risk. So it's about 30 stock before your portfolio risk plateaus, right? Now, and you can do diversification by taking advantage of the correlation between different stocks. And if the correlation is negative, they can cancel each other, right? So I'm not going to go too much detail on that. And I don't think it's on the exam. So let's move on. Now, okay, so we talked about very important notion of discount, present value. And we talked about what is the discount factor, either your cost of capital or your opportunity cost or required rate of return, right? Depends on how you look at it, right? And required rate of return means you have to include risk in your return, right? The riskier it is, they're going to require higher return, right? Now, and I think if you have few of them, let's say you have a required rate of return and also cost of capital, that means you borrow the money, but at the same time you want to invest in a riskier stock, I think you get the higher value, right? Your discount value is going to be the higher of those two. Now that we have this weapon of this present value, we know how to handle the cash flows, then we can value any security. Because any security, any asset is equivalent to a bunch of cash flows. If an asset doesn't give you cash flow, it's useless. Asset eventually and in principle should be able to provide cash flow for you. So an asset is equivalent to a bunch of cash flows. And because we know how to find the present value of the cash flows, we know how to value any asset. Now you are in the valuation business, right? Like Mr. Damadoran is called Dean of Valuation. That means any asset you give to him, he gives you value for it. And it's a big deal, right? Because people usually disagree about that value. Now, among the assets you can have is a stock. A stock has cash flow. What is the cash flow for a stock? It's dividends, right? So then how do you calculate the price of a stock, price of equity? You get that cash flows, okay, which is a dividend. And you divide it by, you discount it back, right? So before that, because there's so much we are covering the whole semester now in 1 hour, it's a little bit packed. Before that, I have to tell you about perpetuity. Who's going to tell me what's perpetuity, guys? It's a lovely thing, right? Perpetuity. What did I tell you about perpetuity, first class? 5 points bonus for anybody who tells me that.
It does not have a fixed maturity date. Like
No, that's the definition of it. That's not my saying. I said something myself. My code. I said something about perpetuity. I said it's unique in the whole finance. What is that? What is it? Remember anybody? I said the formula of perpetuity is one of the.
About time
No,
frequency.
Ferdowsi wants to say something. Raise hand. What do you say, Ferdowsi? And then Nadia, you can go ahead. Ferdowsi, what is the
I think you mentioned something about time frequency.
Something more artistic than that. Say Nadia. What do you say about perpetuity?
Okay, we got disconnected, but I think you mentioned something about time frequency.
No.
No, a perpetuity, the definition of it, right? Definition is a cash flow, fixed cash flow that is going to be repeated every year until eternity.
Infinity.
Right? Forever, right?
It has the most elegant way of calculating the total value, the net value of net present value.
What about it? What did I say?
It has the most elegant formula.
Hey.
Yay, 5 points for me.
Give it up. Give it up for you. Yes, excellent. I say this is one of the most, if not the most elegant and easy one formula in whole finance, right? And it's a reason for it, right? You have something going all the way to infinity, and this is this ugly, right? And let's say your cost of capital is R, right? So 1 plus R squared, 1 plus R, and then up to infinity, right? And then you add them up, and what do you get? You get the price of the, that's it, C over R. This is like not even beyond freshman dream, right? C by the bar, your cost of capital, right? So, excellent. I gotta give that, now I owe you a potato chips for that experiment. Plus 5 points.
No, you said 5 points.
Plus 5 points.
Meanwhile, I think you are still
5
owing
points have
him.
more value than
You're
potato
owing
chips.
him. I think you're owing someone from the last exercise we did.
Yes, exactly. The
Because
potato
I got 2 bags of potato chips now.
Here we talked about
You need to share it with us.
Yeah, at least the chips.
That was the potato chips. Choose a number between 1 and 100. He chose 27, I think.
Yeah.
29. So he got a potato chips for that. And then now you got this one. Yes. Anyhow, remember this. The most elegant, again, don't quote me on that. That's my impression. Maybe somebody has more elegant, but this is so formula for perpetuity is that cash flow that you are going to get every year divided by R. Now, and there is annuity, and I'm not going to get to that. That means it's not going to be in the exam. But you can derive perpetuity from annuity. You don't need a second formula. Because annuity is 2 perpetuity subtracted from each other. When you subtract to infinity, you get that annuity. I'm not going to go there. It's not in the exam. So that's second good news. Well, now I will talk about the perpetuity. Let's talk about the pricing of a stock, right? The stock is an asset. It's in principle is going to give you cash flows. If you're lucky, and we want to see how do you price of a stock. Now that we know the present value of cash flows, we want to calculate the price of a stock. And the way we do it, we assume this assumption. If you assume it's the same dividend, so a stock is give you the same dividend every year, so it's going to be perpetuity. So the price of a stock is going to be that dividend that you get every year in and out, divided by R. And what is this R? R is required rate of return on that stock, right? This is you get it from CAPM, right? RF plus beta of that stock times RM minus R. Okay, so you plug this RS, your required rate of return here, and then you calculate the value of that stock, right? Usually it's not that easy. Dividend changes, but what they do, they do the first few years and then they assign the terminal value to the stock, okay? Again, I'm not going to go there, but we can't value a stock right now with this present value tree. What about bond, guys? What is bond? James Bond, right? Bond is another asset, right? Why? Because when you hold that piece of paper, It's going to give you cash flow. It's going to give you cash, right? So what is how do you value a bond?
The face value.
No, what is the cash flow that bond gives you? Tell me first.
Coupon.
Coupon only?
Coupon.
Yes.
It's the coupon and the par, the end.
Par value, yes. A coupon, for example, is an annual coupon, 4 years. It gives you one coupon. Damn it. One coupon. I have to be careful with my C's. 1 coupon, 2 coupon, 3 coupon, 4 coupon plus par, right? Par usually $10,000 or $1,000, right? So these are the cash flows. So how do you price the bond? You divide that, right, by what is called YTM, yield to maturity, right? You discount it by yield to maturity of the bond. Yield to maturity is the discount value, right? Right? And I'm sorry, they have to be added. So, but what is this yield to maturity?
Like the IRR.
Yield to maturity is IRR. Excellent. Somebody said, I think Shika said IRR, right?
Yes.
Yes. Yield to maturity is also same as IRR for the bond, the internal rate of return for the bond, right? So that's the rate of return that makes, when you buy the bond at the inception net present value has to be 0. That means the money you pay has to be same as the present value of the cash flows you are going to get in future, right? You pay something now, negative, and you are going to get positive cash flow in future. The present value of those two has to be equal, okay? At the inception of the bond, net present value has to be 0. And that is, this IRR is the discount value that make those net present value equal to 0, right? This is just the definition of a IRR. So this is then again how we price a bond, right? You have the cash flow, you discount them back. What do you use for discount? The IRR or the yield to maturity, all right? All right, again, going with a quick review. Okay, then we talked about these things. Oh, of course, we have to talk about the IRR and NPV that we talked about here and there, right? These are two different ways to evaluate a project, right? NPV, we talked about it quite a bit. IRR is the discount value that make your NPV equal to 0. Okay, that means you get all this cash flow. I just explained it in case of a bond, right? If you discount everything by IRR, your net present value is going to be 0, right? So when you run the Excel and you calculate IRR, what you're going to do with it? You accept the project if your hurdle rate is bigger than IRR, then you accept the project, right? Something like that. Again, that's not in the that is not in the quiz. That is not in the quiz. So let's move on to that. That's another good news. All right. Then I got to go a little bit quicker. Then we talk about market efficiency, right? Which is dear and near to my heart. We talk about market efficiency, and what we said, what is market efficiency definition of it? It means every news is going to be reflected in the stock price immediately, right? Market incorporates information. Market prices reflect the information, okay? So this is the definition of market efficiency. It's a little bit slippery, right? So we got to be careful with it. And then we define 3 kinds of market efficiency: weak, semi-strong, and strong. What was weak? Weak was all the past historical data is reflected in the current stock price, right? The semi-strong was not only stock prices are reflected, historical values, every public information is reflected in the current stock price. That means all the financial statement, cash flows, balance sheet, income statement, all that information, or health of the CEO, whatever, right? Dividends, whatever, everything is reflected in the current stock price. That's a semi-strong. And the strong was that even the private information is reflected in the stock price, right? it becomes more stringent and stringent. But many people don't believe in the strong form of market efficiency, obviously, right?
Like Corona right now, yeah.
What is that, Corona?
Like Corona right now, it's affect stock market.
Yes, yes. So that's
This
in the
is,
stock market.
yeah, this is public, yeah.
Yeah, it's public, absolutely. Now, so after that, then we go to we talk about cost of capital, of course, right? We talked about it a little bit before. Cost of capital is how much money you have to pay to get that money, right? How much interest you have to pay, or so on and so forth. Now, or for a manager that you are, and you will be after this exam, you will be Christian, what do you call it? Christian as financial managers officially. So as a financial manager, you have two sources of capital. Again, you have identified projects, NPV positive projects. You want to take on that project. You can't wait, but you need capital, right? Where do you go? Either you tap your internal earnings, the retained earnings that already you have, or you go outside to the capital markets. You go to capital markets, either you issue bonds, which means, in other words, you borrow, or you issue equity or a stock. Okay? And then you get capital that way, either equity or bond. Each of them has its own advantages and disadvantages, right? And each of them has its own cost of capital. How much bond is going to cost you? The cost of, if you borrow bond, how much is it? Out of debt usually is the same as, let's say if you issue only one, if you issue one bond, your cost of capital is the same as yield to maturity of the bond, right? Or in general term, your cost of debt is risk-free rate, because nobody's going to give you money less than risk-free rate, right? So cost of debt, again, cost of debt is minimum risk-free rate plus you have to pay a spread. And that spread depends on your credit worthiness, right? If you have noticed, I just noticed today when I was thinking of doing review here, if you noticed, Damodaran and many others, when they talk about this cost of capital, when they talk about equity, they bring the CAPM. But when they talk about debt, they don't talk about CAPM. Like CAPM includes also debt, right? CAPM also applies to debt because debt also is asset, right? You can use CAPM for this to calculate the cost of debt. And it has its own beta of debt. But people don't talk like that. They talk like this. They say risk-free rate plus a spread, which is coming from default, right? So one can look into this. They have to be equivalent eventually, right? So one can look into this as a research problem, right? But the way he says it, a lot of people say it, so cost of debt is risk-free rate plus some spread. And that spread comes from your bankruptcy risk, for example, right? Bankruptcy risk, we're going to talk about it as we go on, right? So the riskier your business is, and he had a formula for it, remember? He would divide the EBIT by the interest expense, right? The higher it is, higher ratio was, the lower was your spread. You need too much money for what you're borrowing, right? The lower this ratio is, the higher is your risk. Anyhow, so that would be the cost of capital for the debt, cost of capital for equity. We talked about it. You get it from CAPM. And what is this? It's from the manager. This is the cost of capital for equity. Is my voice good now? Is my voice good?
Professor, we can hear you.
Yeah, that's what I realized. Whew. Is it better now?
Yes.
Okay. So again, this is going to be, this is cost of equity for manager. This is cost of debt for manager. This is cost of equity for the manager, right? Again, risk-free, let's plus pay down the company, or risk is the companies, and so on and so forth. This is cost of capital for the manager and the for the investors. So now you have your RD, if you borrow, and you have your RE, if 2020 issue stock. Right? And then you find something that's called weighted average cost of capital, right? Back.
It's still breaking.
Okay, back, and then you have to, is a weighted average. So you go E divided by plus E okay, so this is your weighted average cost of capital. Weight of equity
minus yet one plus minus tax.
Excellent, correct. So this is the weight of equity. It just is this defaulting. It kills me. It crumbles these letters. Yes, times RD. And as Farnos said, the government comes in. Government comes in and subsidizes it at length at your discussion, right? A subsidy. Subsidizes your debt. All right. So this is your back. This is your cost of capital. All right. Now, last one is now you know what's your cost of debt, you know what's your cost of equity, and the question is there any way that you can capitalize or finance your projects, increase the value of your company, increase the value for your shareholders? Is there any combination? Is there any optimal combination between C and D or your leverage, right? Is there any specific leverage like 50%? This maximizes the value of your enterprise, right? What is the answer to that? Is basically value of company, does it depend on the ratio of the debt to equity or no, right? So if you look at the balance sheet, this is your assets, and this is your debt, this is your equity. The value of company only depends on the right side or depends on the left side, how much equity you have, assets you have. Doesn't matter how you get those assets. Which one? Yes? Anybody, guys?
No, we're okay, but you were breaking. That's
We
what
didn't even hear you, Professor.
No, my question is this: is capital structure matters? Is the ratio of equity to debt matters for value of your company?
Depends on if it's on theoretical world or real world. In real world, it does. In fake world, it doesn't.
Yes. In an ideal world, in a perfect market, Miller-Modigliani says, very important, right? Miller-Modigliani, these guys won a Nobel Prize, right? They say it doesn't matter. They say capital structure doesn't matter. Guys, there's the background noise again. They say it doesn't matter. They say what matters is the asset side of the balance sheet, not the left side. The right side matters, assets. You're operating assets. How much money you make if you're running a lumber stand, right? If you run a lumber stand, how much money you make? It depends how many juicer you have, how many table you have, how many cups you have, how much sugar you have, right? It doesn't matter how you bought those sugars or cups. You borrowed or you use, right? It's how much machinery you have, how many workers you have, right? But This is Miller-Modigliani.
You also mentioned that the capital structure of a firm is independent of its value.
Yes, that's what they say. I don't say that. Miller-Modigliani says that. Miller-Modigliani says the value is independent of capital structure. Says don't worry about capital structure. It has no bearing on your value, right? They say that. But they say that with a bunch of conditions. The conditions are this. There should be no tax. There should be no bankruptcy. Very good word.
No transactions.
No transaction costs. And also no, what is the last one?
You mentioned to hold constant the firm's investment policies.
Yes, this decision should not, like, it should not impact your decision, your investment policy. That means you're take a project, you're still going to take it on, right? You're not going to touch your projects. And there is another one, which is no asymmetry of information, right? If all these things holds, then capital structure doesn't matter. But if one of these conditions is violated, then capital structure matters. For example, if there's a tax, capital structure matters. If there's a chance of bankruptcy matters. And if there's the asymmetry of information, capital structure matters. So in short, capital structure in real life matters because debt has positive side and negative side. Because debt is tax deductible and because the government subsidizes debt, it looks like the more debt you take on, the better you are off because your cost of capital is going to go lower, right? So let me tell you this. So to maximize the value of your firm, you want to minimize your WACC, right? And this WACC was RD and RE, right? And RD is less than RE in any condition, right? RD is less than RE because government subsidizes it. And because the cost of debt is less than cost of equity, because debt holder get their money first. Remember? Debt holders get their money before even you pay tax. Equity holders get their money after the tax from the profits.
So financial decisions do not matter in a capital structure.
Yes. No. If we are in a Miller-Modigliani world, then capital structure doesn't matter. If we are in a real world, it matters. Actually, this is very famous. That the graduate student, MBA students graduate, go out and they keep saying, oh, capital structure doesn't matter. No, that is Miller-Modigliani. In real world, if there's tax, if there's bankruptcy, if there's asymmetry of information, capital structure do matter, right? And that's what I want to prove now, right? So your WACC is a function of cost of debt and cost of equity. Cost of debt is cheaper than cost of equity. So it makes sense to borrow more than issuing a stock because also government gives you subsidizes the debt, right? But debt is good to a point, right? So if let's say this is the equity value, right? The more you borrow, the value of this is value of the firm, right? And this is debt. When you borrow, the value of the firm increases. But then it comes a time that you run the risk of bankruptcy, then value decreases. So this is going to be your optimum debt value. Okay? Because debt at the beginning helps because it has lower cost. But as you accumulate more and more debt, you are going to run the risk of bankruptcy and financial stress, and that's going to increase your cost, right? So that's why there's an optimum level of debt or optimum level of leverage that you as a financial manager have to figure it out, okay? There is an optimal level of debt, and that is the optimal capital structure, and that maximizes the value of your firm, right? So again, don't go out and
See, what's confusing for me, Dr. Majid,
yes,
is that when you mentioned that when you talk about bankruptcy,
yes,
and then you talk about costs, how come when you file for bankruptcy, then you increase your costs?
Yes, we talked about it, right? First of all, you don't need to go bankrupt so to increase your cost. The moment people realize you are in trouble, right? The first you borrowed the 20% debt, right? 20% of capital structure is debt, right? The more you want to borrow, they are going to increase your cost of debt. Cost of debt automatically is going to go higher, right? And then, right? For example, these cruise companies, right? Cruise line companies, right? They didn't go bankrupt. They wanted to borrow, but people said, okay, here's 18% debt. If you want a loan, here's 18%, give it to me, right? So already the loan price went up, the cost of capital, cost of debt went up, right? And then, so this is before they go bankrupt.
So who's going to lend you money if you are bankrupted?
No, hold on. Then when you become bankrupt, then bankruptcy itself has its own cost, which is the cost of attorneys and court and so on and so forth, and you lose your suppliers and so on and so forth. So bankruptcy, either financial state or bankruptcy, both of them are costly. Okay? So if you exceed beyond certain limit, you cannot borrow, right? Because you get a tax subsidy. The more borrow, you are going to put yourself at the risk of bankruptcy and financial stress. Again, you don't have to go actually bankrupt. The moment you exceed your limit and market realize you're exceeding your limit, then the cost of debt is going to go higher. And one of the measures is this, right? One of the measures.
But many companies, when they file for bankruptcy, that does not mean that they don't have cash flow. They may have a lot of cash flow, but they do file bankruptcy in order to settle with banks. So there is, I mean, and I've seen that a lot. So.
Right. People take advantage of debt to dispose some of their debt, bankruptcy to dispose some of their debt. But we are not talking about that. We are talking about that if you are financially stressed, this is going to go higher, or D is going to go higher. That's all we are talking about. You're going to, cost of debt is going to increase. That's what we are talking about. Okay, guys. And then eventually we talked about dividends, right? And we said, again, Miller-Modigliani said, payout doesn't matter. In the ideal world, in the perfect market, payout doesn't matter. Guys, background.
Would you please repeat that? Sorry.
Yeah, then people mute yourself.
What did you say about interest coverage, EBIT over interest expense?
What about it?
I thought you mentioned something about it in relation to the amount of debt. Okay, don't worry.
Yes. The more debt you have, the cost of your debt is going to go higher. First of all, we realize the moment you have debt, you increase your debt, even your cost of equity is going to go higher, right? If you borrow, cost of equity, your beta is going to go higher, your cost of equity is going to go higher. But also, the more you borrow, your cost of debt is going to go higher, okay? Because you become financially stressed, people are going to charge you more for debt. Instead of 5%, they are going to charge you 12%, right? If you increase your, if people realize you are financially stressed, right? If your revenue compared to your interest expense is not much, then people are going to increase your cost of debt, right? So this is
okay. So the more debts that you have, the more costs you have.
Yes, cost of debt. Yes.
Okay, the cost of equity also.
Cost of equity also, yes.
Yes.
I talked about in detail why, because it doesn't make sense that the more you borrow, the cost of equity also goes up. That doesn't quite make sense, but I showed to you why it works. Because I showed you borrow more when you have leverage. When you have leverage, your equity becomes more riskier, right? The variance of your return is going to increase. Okay, your equity becomes more volatile. If you have more debt, your return on equity becomes volatile. Because this is leverage, right? Leverage means it exaggerates return on your equity. That means if you were doing good, you are going to go very good. And if you were doing bad, you are going to do very bad. So debt is going to exaggerate your return on your equity. And exaggeration means more variance, means more risk. So cost of equity is going to go higher. We talked about it in detail, and which is very interesting, right? So the more you borrow, your cost of equity also going to go higher. All right, and then finally we talk about dividend and payout policy. So as a manager, now you have a bunch of cash leftovers, right? Retained earnings. As a manager, and also that's also a matter of capital structure. Should you keep that earning to yourself or should you distribute it to the shareholders? That's a decision you have to make as a manager, right? That's your payout policy, right? And we looked at it, so you can either retain dividend or you can buy back stocks, right? Each of them has pros and cons. But this, again, Miller-Modigliani said, payout policy doesn't matter. It's irrelevant, right? It doesn't do any good or bad to the company if you pay dividend or don't pay. But again, those conditions should hold. No tax, no bankruptcy, nothing, right? But in real life, that those conditions are not satisfied, so dividend matters. Because when you pay dividend, shareholders have to pay tax, and they have to pay income tax instead of capital gain tax, right? So you have to consider all those options. But the only thing that actually no matter what you look at it, it doesn't look like paying dividend is going to benefit the shareholders, right? Because they are going to end up paying tax.
So the lower is the payout ratio, the lower is the dividend.
Yeah, no, that's a definition. Payout ratio, yeah, payout ratio is how much of your net income is going to pay for dividend. So obviously the higher the payout ratio means the more dividend. That's definition, right? Now, but the only thing that looks like it's going for dividend, because dividend has a negative side because you have to pay tax and you have to pay tax, high tax. The moment you get the dividend, you have to pay tax, right? So that doesn't seem to be a good idea to give dividend. The only thing that seems to justify dividend is this asymmetry of information, right? You talked about it. That means management can signal to the shareholders that they are doing good. Because management is not willing to pay dividend if they don't think the future is bright, right? Because of the stickiness of dividend. Managers, if they pay dividend, they want to keep paying that dividend, right? So if they feel they cannot continue paying that dividend, they are not going to initiate the dividend. So if the management initiates the dividend, that sends a very strong signal that the company is doing good and its prospects are bright, right? Because talk is cheap. Management can have a news conference and can tell you all about the future growth and bright future, but nobody's probably going to believe them. But if they initiate a dividend, people are confident that the company is doing good, right? So asymmetry of information when it comes to the paying dividend or a stock buyback is something that logically makes sense. All right, guys. So that is a very compact and intense review of the course. Anything probably I didn't cover is not going to be on the exam. I mentioned some of them explicitly, like IRR, I don't think is there. Even NPV is not there. That's a shame. But you will see shortly what is there. There are 15 of them. There are 15 questions and 100 points. And you know by your mathematics, if you divide 100 by 15, nothing nice comes out, right? So what I had to do, I gave 10 of them 7 points and 5 of them 6 points. Okay, 10 7 points and 5 6 points. So it gets us to the 100. All right, guys. Now, Parnaz, are you there?
Yes, doctor.
Do they need a password?
For sure. All the exams except quiz, they have the password.
Okay, so
do we need to take a break?
Yes, take a break. Absolutely, yeah. As a matter of fact, take a 10-minute break, because now you can go back, review your notes or something. If maybe you just understood something or something, right? Go take a 10 minutes break or even 15 minutes break. Have some tea. Make sure your back is not bothering you. Relax, and then come back. And then I find the password for you guys. Okay.
Okay.
Passport is going to be Miller-Modigliani. All right. All right, guys. So
the final exam has a password?
I think so, yes. I'm going to have to find it, yeah.
Okay, so we'll be back in 15
right now,
minutes.
Yeah, right now there is going to be 15 minutes break.
Okay.
Okay, I'm going to stop recording. All right.